Hi, I'm Victor. I'm an active value investor and I enjoy recording videos on the companies that I invest in, sharing that on YouTube and giving other investors my analysis so that it could help the individual investor community out there. I've benefited greatly from watching other YouTubers that share their investing techniques, strategies, and specific analysis on stocks. I wanted to share my analysis on Big Five sporting goods in this video. They announced their earnings today. I was able to update my analysis on this company and make a decision whether I want to continue to buy shares in Big Five, just hold my shares, or sell my position in Big Five sporting goods. I like to scorecard my investments, and it's four basic questions followed by an action item. First question: do I want to be in this industry? Is the company I'm evaluating operated and performing well? Is debt less than 3 times EBITDA? And I want a discount on the stock. That way I can see my investment go up in value. Based on the answers to those questions, I decide whether to buy, hold, or sell my position in Big Five. Big Five Sporting Goods is a discount retailer. They specialize in providing sporting goods and athletic shoes, all the items you need to play sports outside or go fishing, camping. They have a store that really caters to activities that you would do outside. I like the company. I've bought Big Five items for more than 30 years, and I think they provide a really good value when it comes to footwear and apparel, as well as other items. Big Five enjoyed a really good 2020 and 2021 years when the pandemic really caused everybody to go outside. Nobody wanted to be inside where they would be around other people. So doing things outside became really popular, and Big Five had a huge boom in revenue. So they made lots of money, lots of free cash. And now 2022 is the first year of it coming back to normal. And they released their earnings today and provided that information to us. First off, it was really good to see that they are profitable, and they made $52 million of EBITDA in 2022, which was really good. Last year was just a boom period of 152 millions of EBITDA. Keep in mind, their market cap is 250 million, if that. So they were making almost as much EBITDA as their market cap in 2022. Balance sheet's in great shape. They have a good cash balance, not as high as last year. They paid a dividend. They also built up their inventory, and they have no debt. That's great to see in a company. And their shares have been fairly stable. Not a lot of new shares have been issued. So good balance sheet. Taking a look at their income statement, again, their sales and their gross profit were really good in 2022. It shows it's January 1, 2023. They ended their fiscal year on the very first day of 2023, but it really is 2022. So good profitability overall, and operating income of 33 million. It was lower than 2021, and principally because 2021 was just such a record year. And overall, just a healthy company, net income of 26 million, and really, really good operated company. I value companies based on the free cash flows I expect in the future and discount those free cash flows to today's dollars. In the case of Big Five, they provided their financial statements, but they didn't provide a statement of free cash flow. And therefore, I have to really estimate where I think free cash flows came in for 2022. And I'm expecting that it's going to be about 35% of the number they produced in 2021, based on the gross profit that they produced and so forth. That number ends up being approximately $35 million per year. I'm going to go really conservative and expect the company's not going to grow that free cash flow, both short-term and long-term. So it's going to stay at 35 million and really develop a terminal value of 350 million. I'm going to discount those free cash flows in the future by 10%. It's a very high weighted average cash cost of capital. This is a smaller company, so it's a higher risk profile, but they do have an excellent balance sheet. So it's not because their balance sheet is in bad health. It's just that they're a small company. So I'll just be conservative. Based on those inputs, I get a value of the company of $328 million of market cap. But their current market cap in the marketplace is $222 million. So it offers up a nice discount of 68% when you look at the share price that it's at today and the intrinsic value that I believe each share is worth. So 68% discount. One more method of determining, the share price or the share value is looking at their dividend. They pay a great dividend, 11%. And if I just take that dividend and discount it by 10%, zero growth rate, I get a $10 per share. So just on the dividend alone, it's worth more than what it's currently priced. Big Five has been performing really well for the last 3 years. They were profitable in 2022 and really got their business on track with having the right inventory in 2022. They pay a great 11% dividend, just phenomenal dividend that they can afford to pay because they have an excellent balance sheet, no debt, and they produce free cash flow. This is a discount retailer and we're going into a recession. So they have the right catalog to sell into a market where, shoppers are, watching every dollar they spend. They're going to pay a really good dividend. Now, 11%, if they sustain that, that'll be phenomenal. But even if it dropped more, to 5%, it's still a really good dividend and the company is in good health. They're going to have negative growth of 4 to 6%, mainly because they had record years in 2021, 2020, and it's really hard to compare to those years. They'll continue to produce free cash and profits. And therefore, I think it's just a great value to own Big Five. They have high upside on the stock, especially if other investors realize that, hey, this is a place where you can get a really good dividend. And there could be a short squeeze. There was one on this company before, and it could happen again. So let me scorecard Big Five. It's an industry that I want to be in. Retail is always in my portfolio, and I like having a discount retailer that's very well operated and performing well. The debt, it couldn't be any lower. It's zero, and therefore way below 3 times EBITDA. Discounted stock, therefore I'm going to continue to buy shares. I have a medium to large position in Big Five, and I'll continue to add to my position. Thank you for watching the video. Hope you found it interesting, discovered something new about Big Five. Keep in mind, I'm just sharing my journey as an individual investor. I make no recommendations for you to buy any particular stock or bond. Good luck investing in 2023.